Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Weekly Update for the week of June 22nd. My name is Fritz Folts, and I'm the Chief Investment Strategist here at 3Edge, and pleased to be joined here today once again by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. As we do each week, Steve and I will provide a brief update on the global capital markets, and we'll take a closer look at a particular topic which we hope could help our clients to better understand the current market environment. In terms of a market recap, recent troubling reports about a surge in the number of new cases, in particular an increase in hospitalizations from COVID-19, have investors at least hitting the pause button on the equity markets, which recently seemed to be up one day and then down the next, a scenario sometimes referred to as sideways chop. Investors are clearly concerned that a resurgence of the coronavirus could lead to a significant pause in the reopening of the economy, thereby casting doubt on the potential for a V-shaped recovery. So let me bring Steve into the conversation here. Steve, it seems to me that the only equity index that investors ever think or talk about is the S&P 500. And I know that makes a certain amount of sense, since the U.S. equity market and the S&P had experienced an historic bull market run, which began back in March of 2009, dramatically outperforming ex-U.S. equities, for example, over that period of time. But my point is this. In my experience, when everybody seems to be talking about and investing in just one asset class, there don't seem to be any good alternatives. It's probably time to start thinking about and looking for alternatives. So I was thinking that perhaps it would be helpful if you could discuss first what potential triggers could cause the U.S. equity markets and the S&P to begin to underperform, and two, what other asset classes might be poised to outperform in such a scenario.
Well, Fritz, you're absolutely right. The U.S. stock market is outperformed other countries for what seems to be a very long time. But if I think of possible triggers that could reverse that outperformance to underperformance relative to other markets, one that comes to mind is a potential reversal of the corporate tax cut. In 2017, there's a very sharp tax cut that translated directly into a big bump up in earnings without any other changes. That fed directly into a bump up in stock prices. And in the same way that a tax cut really helped stock prices boost higher, a reversal of that, of course, would work in the opposite direction. Secondly, we also know that a big support to the U.S. stock market, and bigger in the U.S. than any other country, have been stock buybacks. Stock buybacks have represented lots of the demand for U.S. stocks over the last few years. Now, with the coronavirus, with the recession, with the slowdown, with balance sheets getting more tenuous, stock buybacks are slowing down. And the longer the recession goes on, the less you should see stock buybacks. Third is the relative success that different countries might be having over time containing the coronavirus. We've seen examples where Europe got hit very hard after Asia got hit very hard, then the US got hit hard. Now we see Europe coming out of it with a lot more control, Asia coming out with it with a lot more control, and the US still struggling. So if the US fails to contain the coronavirus in a way that's not as good as these other markets, that could be a relative factor. And then finally, a lot of the boost more recently to the US market has been from the extraordinary stimulus from both the Federal Reserve Board with monetary stimulus and the government with fiscal stimulus. And if that were to hit the pause button, either because the market has been doing so well, the stock market that is, or a sense that the economy is rebounding sufficiently, then maybe that pause removes one of the props to relative outperformance. So if you put it all together, it is true, as you say, that most investors, when they consider their whole equity allocation, they've been very focused on U.S. equities. And often in the short term, it's good to invest based on relative strength. You go with the trend. It's human nature. And yet, a lot of the machines that are now responsible for day-to-day trading, they have sophisticated algorithms, but when you dig down deeply, you find that they're basically momentum or trend following algorithms. Valuation, which is very important to a long-term investor, means very little in the day-to-day or the short term. Right. But we know from our studies it's extremely important determinant of long-term future returns in many of our clients or certainly long-term investors. Now, I'd like to share this chart that you prepared on behalf of our listeners that does show the tremendous outperformance of the U.S. stock market relative to German stocks, relative to Japanese stocks, relative to emerging market stocks, and especially relative to commodities, which is trailing. This is tremendous outperformance, but we do see this pendulum swing back and forth decade to decade. And so what we'd like to point out is that this tremendous outperformance of the U.S. stock market is way out of proportion to the relative difference between the economic growth in the U.S. versus other countries. And what that means is that we are now at the widest valuation gap, or the biggest difference between how overvalued U.S. stocks are compared to how fairly valued or undervalued the rest of the world is. That gap is stretched now to the widest it's ever been, with one small exception, and that was at the very top of the tech stock bubble right before it burst. Wow. We all know what happened after that. Not only was it trouble for the U.S. market, but for nearly a decade, U.S. stocks underperformed the rest of the world.
Makes me remember pets.com. So that's really helpful, and that's actually an amazing chart when you actually see it there in living color, how the U.S. market is so outperformed. But I want to switch gears here a little bit and shift our attention back to the Fed and their unprecedented intervention in response to COVID-19. And I want to speak briefly or ask you about a topic known as financial repression, which kind of sounds a bit diabolical, but it's really just a way to think about the massive intervention from the Fed, whereby, my understanding, it's the central banks are seeking to make certain asset classes, perhaps cash and bonds, so unattractive as to force investors into risk assets, such as equities. So maybe helpful if you were just to describe exactly what financial repression is. Importantly, have we arrived at financial repression here in the U.S. yet? I think I know the answer to that one. But more importantly, so what are the potential implications of such a policy on the global capital markets?
Well, as you say, Fritz, there's a lot of speculation that we might repeat what we did after the Great Depression and World War II, which is to engage in financial repression. And I would maintain that we are there today. Mm-hmm. Financial repression is when either the central banks, like the Federal Reserve Board, or the government drives interest rates so low, either through monetary policy or through regulation, so that corporations and governments are able to borrow at way below market rates, at unfairly low market rates. So it helps governments, it helps corporations. Who does it hurt? Well, it takes away fair compensation from savers or bondholders who are lending that money. So it's a way to subsidize the governments and corporations on the backs of savers and bondholders. And that's happening right now. We have interest rates that are so low, they're below the rate of inflation. They're much lower than what corporations or governments would normally need to pay to borrow money, given all the high debt levels that exist, except for the Fed stimulus. And if we look back to how this resolved itself after World War II, despite everyone saying that we haven't had inflation back then, for decades, we'll never have it again. With all that financial repression, inflation did come back. We could see that again here, or we might see another form of inflation, which is currency devaluation. When you just print so much money, the value of that paper money comes into question.
Great. So I have a little follow-up question to that, and that would be that if we are experiencing this now, and from the Fed, from the U.S. Central Bank, so that clearly impacts U.S. markets, but what about ex-U.S. markets? For example, are there examples of how this massive intervention by the Fed, this financial repression, could benefit ex-U.S. markets? Maybe emerging market equities or commodities come to mind?
That's right. And sometimes people don't focus on this because it's a second order effect. Because it's the Fed, it's in the US, they think it only benefits the US. But there's been a lot of borrowing overseas in US dollar terms. And so when the Fed acts in the opposite way it has recently, when they tighten rates, when they squeeze the financial system, it's really difficult on emerging market companies and other international companies that have borrowed in US dollar terms, because not only do they struggle to pay off those loans, but as the dollar appreciates, it makes it even more difficult to convert their currency into dollars and then pay even more to pay off those loans. On the other hand, when the Fed acts in a very dovish way, when they act with very low rates and they print lots of money, that's of great benefit to emerging market companies and other companies around the world that do borrow in dollar-based terms. Also, if you think about real assets like commodities or gold, they are priced in dollars. And typically in a normal economy, if you put your dollars to work in a financial asset, in a bond that doesn't have financial repression, you're going to earn a nice rate of return way over and above inflation. Right. Today, the return is below the rate of inflation. So rather than be the one that's subsidizing everybody else and assuming a rate of return for less than the inflation rate, often that's when it's a good time to be in real assets.
Very good. Excellent. Thank you very much. So one thing that I was reminded of during today's discussion is how we actually utilize our research model and our tactical approach to seek to invest in undervalued asset classes that we believe could be poised for a period of market outperformance while avoiding asset classes that may be poised for a period of market underperformance. And it reminded me, since we're looking at other assets compared to or relative to the U.S. market, it reminded me of a chart that you know very well that we see in our industry all the time called the patchwork quilt. And so here we'll show this chart. Basically, the patchwork quilt chart is very straightforward. It illustrates the performance for each calendar year for a variety of different asset classes. This one happens to be over 20 years, from 1999 through 2019. And as we know, different asset classes perform differently from year to year, oftentimes dramatically so. And so I was thinking that in some respects, we're seeking to do this, to work this patchwork quilt and position our strategies, seek to overweight those assets that could outperform over the coming 12 months or longer, and then seeking to underweight or perhaps even avoid entirely those asset classes that research model indicates could underperform over the next 12 months or longer. And I don't know, I thought that referring to the patchwork quilt could be a reasonable way to explain our investment objectives here at 3Edge Asset Management on behalf of our clients. So that will do it for us. Steve and I have a programming note for you, though, and that is that we will not be recording our weekly update next week in observance of the July 4th holiday, but we will be back the following week with another edition of the 3Edge Weekly Update. Remember, all of our videos are available on our YouTube channel. And in addition, if you have any questions or suggestions for a future topic, please feel free to send those ideas along to us via our website at 3edgeam.com. So on behalf of Steve and everyone here at 3Edge, we urge everyone to remain safe and healthy and have a wonderful 4th of July. Steve, thank you again for your time and your valuable insights.
Thank you, Fritz.
And thank you all for listening.